Okay, good morning, grade 12s. Today I'm sending you this PowerPoint that you need to just watch and listen through. I'm going to explain the complete format of the cash flow statement, and then tomorrow I'm going to do one exercise with you so that you can see exactly how it works. Okay, so what is the main purpose of a cash flow statement? Just some revision. It is going to show us how cash was generated. Okay, so where the business is receiving money from. And then also how cash was utilized. So what the business is using the cash for. So basically the inflows and the outflows of cash. The cash flows into the business and then the cash flowing out of the business. Outflows will always be bracketed. Inflows will always have no brackets. The activities of a company is classified into three categories. It will be the three sections in the cash flow statement. The first one is our operating activities. The second one, the financing activities. And lastly, our investing activities. If we look at the different components of the cash flow statement, first of all, the cash flows from our operating activities. This will be the activities where we generate our income from. Okay, so the main income activities, things like the buying and selling of inventory, okay, our sales basically, receipts from debtors, if we have sold on credit and they start paying us, our payments that we are making to creditors, if we've bought trading stock, whatever it was, on credit and we pay for that, and then any expenses that we incur during the day-to-day running of our business. The second component is the cash flows from our investing activities. And this will be cash flows as a result of the buying or selling of tangible assets. Buying would be an outflow of cash. Selling will bring an inflow of cash. And then changes in investments. When we make an investment, it would be an outflow of cash. Last category is the cash flows from our financing activities. This includes cash flows that is involved in the funding of our activities. So where is the funding from our business coming from? And this will be the sale and the repurchase of our shares. When we sell more shares, issue more shares, there will be an inflow of cash. When we do a repurchasing of shares, there will be an outflow of cash. And then the receiving and the repayment of loans. When we receive more loans, it will be an inflow of cash. And when we pay back some of our loans, it would be an outflow of cash. So where are we going to find the information to complete now the cash flow statement? First of all, we are going to look at the income statement or the statement of comprehensive income. Then we also look at the balance sheet or the statement of financial position. And lastly, there might be some additional information that they're going to provide to us to explain certain figures, much like the adjustments that you are used to. Okay, so if we look at the income statement, what information that we are going to use out of this income statement are we going to put in the cash flow statement? Everything from sales, okay, from sales all the way down to net profit before tax will be captured as operating activities in my cash flow statement. The income tax will be disclosed separately. All right, you will see when we do the format, we show income tax separately. It is not included as part of the operating activities. Then if we look at the balance sheet, okay, if we look at the assets, the section in the balance sheet on the assets, your tangible or fixed assets, as well as your financial assets, will be captured under investing activities in the cash flow statement. If we look in the balance sheet at the section of equity and liabilities, your shareholders' equity and your non-current liabilities will make up the financing activities in the cash flow statement. Okay, so this is the complete format of the cash flow statement. We will have the cash flows from operating activities, which is made up from the cash generated from operations, note 1. We will have interest paid, dividends paid with note 3, taxation paid in note 4. You will see all of these amounts are bracketed. Okay, all these amounts are bracketed because they will constitute an outflow of cash. Okay, we are making payments. When we pay interest, when we pay dividends, when we pay taxes, there will be an outflow of cash because money will be flowing out of the business. If we look at the cash flows from our investing activities, the purchase of non-current assets, you will notice also is bracketed because when we are purchasing non-current assets, it will be an outflow of cash. When we pay for the assets that we are buying, there will be an outflow of cash. On the other hand, the proceeds of sales from our non-current assets, okay, when we are selling assets and we are receiving money for the assets we are selling, that will be a cash inflow. Okay, so you'll see that there is no bracket there. All right, because there is an inflow of cash. Proceeds are the investments. Okay, investments matured or repaid. If the investments are maturing, it means that we are getting our money back. Okay, the money that we have invested will come back to us. Okay, that is why it is also not bracketed because there will be a cash inflow. When we make the investment, it is an outflow. When that investment matures, it comes back to us and then there will be a cash inflow. Right, if we look at the cash flows from financing activities, the proceeds from the issue of shares and the proceeds from long-term borrowings, you will see they are not bracketed because they will cause an inflow of cash. When we are selling more shares, we will be receiving more money for the shares that we are selling, so an inflow of cash. Proceeds from the long-term borrowings, when we borrow more money, when we receive loans, that is also going to cause an inflow of cash. But when we repay those loans, okay, you'll see the payment of long-term loans, when we pay the loans back, that when we make a payment will cause an outflow of cash and therefore the amount will be bracketed. Okay, when we calculate then the net change in cash and cash equivalents, you will see this is going to be your balancing amount. All right, so that will be the missing figure that you are going to be calculating. You're going to work from the top down. Okay, so cash flows from operating activities plus the cash flows from investing activities plus the cash flows from financing activities. Or you can work from the bottom up. If they give you the cash and cash equivalents at the end of the year, okay, if this is given, cash and cash equivalents is at the end of the year, and they give you the cash and cash equivalents at the beginning of the year, we can work upwards, okay, to work out the net change in cash and cash equivalents. So this you can work both bottom down, bottom up, and top down. All right, so two different ways of doing this. Okay, so this balancing amount, the calculation of the net change in cash and cash equivalents, this is the reason why we prepare the cash flow statement in the first place, because we want to know, is there an increase or a decrease in cash for the year? Did we have a net inflow or a net outflow of cash for the year? In this example, you will see here that the amount is bracketed. This means that it would be a cash outflow, a net cash outflow for the year. Okay, so if we now look at the different notes quickly, note 1 represents the reconciliation between profit before taxation and the cash generated from operations. Okay, you'll see we have profit before taxation. This obviously comes from your income statement. Then we are going to make some adjustments. There's an adjustment that we have to make for interest paid and for depreciation. When we prepared the income statement, we subtracted the interest expense. But now we are going to add it back. Okay, from the profit before taxation, we add the interest back because we are going to disclose it separately in the cash flow statement. Okay, this is going to be shown separately, so it's not going to be shown as part of our operating profit. Okay, we're also adding the depreciation back. When we calculated the net profit in the income statement, we deducted depreciation as part of our operating expenses. But when we calculate depreciation, it has no effect on cash. Depreciation is not something that we actually pay. So there's no actual expense, no cash coming in, no cash coming out. So we are going to add this amount back because it doesn't affect the cash flow statement. From there, we are going to take the profit before taxation. Then we're going to add these adjustments. Okay, we're going to add back the interest that is paid, the interest expense, and we're going to add back the depreciation, and that is going to give us the operating profit before changes in working capital. Okay, then when we calculate the changes in working capital, it can be either an increase or a decrease in inventory. You'll see it has its own note. Okay, we're going to talk about inventory. Then it can be an increase or a decrease in trade and other receivables, and an increase or a decrease in trade and other payables. If your inventories increases, it means that there was an increase in trading stock. That trading stock was bought, so it's going to cause an outflow of cash. Therefore, if the amount is bracketed, it shows us that there's an increase in inventory. Same with trade and other receivables. If there is an increase, it means that more cash was flowing out of the business. But with trade and other payables, obviously the opposite is true. A decrease will be bracketed because a decrease means that there was an outflow, a net outflow of cash. Okay, so from there, we are going to take the operating profit before changes in working capital. Then we're going to add these three amounts together. Okay, change in inventory plus the change in trade and other receivables plus the change in trade and other payables is going to give me the change in working capital. So the operating profit before changes in working capital plus the changes in the working capital is going to give me the cash generated from operations. Okay, and that will give you the answer then for note 1. Okay, what is important is that here by trade and other receivables, trade and other payables, remember SARS income tax can be, if it has a debit balance, it is going to fall under trade and other receivables. If it has a credit balance, it will fall under trade and other payables. But in the cash flow statement, we are going to exclude SARS income tax because it is shown separately in the cash flow statement. Okay, so when we calculate these changes in trade and receivables or trade and other payables, we have to exclude the income tax. Okay, if we just look at note 1, most of this information I have said already. Okay, in terms of depreciation, okay, it does not involve an inflow or an outflow of cash. Okay, the bank account is not affected by depreciation at all because it's not an actual expense. It is a tax allowance that we are treating as an expense, but it's not a real expense. No money is being paid for depreciation. It is just an adjustment that we are making. All right, so it was originally when we calculated the net profit on the income statement, it was subtracted to get to the net profit. So now we have to add it back to eliminate the effect of the depreciation on the net profit because it doesn't affect the cash flow statement. The interest on loans, okay, that is a financing cost, not an operating activity. So on the income statement, it was subtracted to get to the net profit. Okay, so in order to calculate the net profit, we subtracted the interest on the loans. Now we have to add it back to eliminate the effect that it had on the net profit. And then we're going to deduct it again on the face of the cash flow statement. In other words, we show it separately. Okay, it's not shown as part of the operating activities. We show it separately on the cash flow statement. Lastly, the taxes and the dividends that was paid. This on the cash flow statement must be deducted on the face of the cash flow statement. So when we go to note 3 and note 4, we are going to calculate the amounts that was actually paid. And this is always, it's going to be a payment. Okay, taxes and dividends is always going to be a payment. So it is always going to cause an outflow of cash, which means that it is going to be bracketed. Okay, so we don't include the taxes and the dividends, okay, because it is going to be shown separately. If we look at note 2 gives us the amount of cash and cash equivalents, right? So obviously there can be different entries here. It depends on what accounts the business is working with. There's always going to be a bank, okay? So if we calculate, what we are looking for is the net change. All right, we have year 1, let's say 2019. We have year 2, let's say 2020, okay? So to calculate the net change for the bank, for example, we are going to take year 2, okay, the value, this value for year 2, okay, whatever this value is for year 2, and we are going to minus the value for year 1, okay, so whatever this value is, okay. And if this value minus this value is negative, okay, so in other words, this value is small, this value is bigger, that is going to give us a net cash outflow, which is why that would be bracketed. Obviously, if the amount in the bank, the balance in the bank was bigger in year 2 than what it was in year 1, there would be no brackets here because they would have been in cash inflow. Okay, we do exactly the same with cash flows, right? Year 2 minus year 1 is going to give me the net change. Year 2 minus year 1 for petty cash is going to give me the net change. And then we are just going to add these three amounts together to get the value for the changes in cash and cash equivalents. What is important to remember, the net cash in cash and cash equivalents will show an inflow or an outflow. It obviously depends on what is going to happen during the year. If there's an inflow, there would be an increase of cash, and this amount would not be bracketed. If there was a decrease of cash, in this case, there was a decrease in cash because it is bracketed. Okay, so in this case, we can say that there's a decrease in cash because this amount was bracketed. All right, but it can be positive, it can be negative. There can be a net inflow, there can be a net outflow. We have to see what information is given to us. And then very important also, if the bank is in overdraft, the amount will be shown in brackets. Okay, so if the bank has an overdraft balance, these numbers here, okay, in this case you will see it was both positive because there's no brackets. The bank had a debit balance. But the minute that the bank has a credit balance or an overdraft, these amounts are going to be bracketed, all right, because it shows an outflow of funds. If we look at note 3 represents the dividends that we have paid. We are going to start with the amounts in the financial statements. You will see this amount is always going to be bracketed because it represents an outflow of cash. We then add the balance at the beginning of the year, which also will be bracketed because it represents an outflow. Both of these amounts have already been paid, and this is why it's a payment that constitutes an outflow, which is why it is bracketed. We then add the balance at the end of the year, which will not be bracketed because it has not been paid yet. And that will ultimately give us the dividends paid during the year, which will always be bracketed because it is paid. Anything that is paid constitutes an outflow of cash. The calculation of this amount, or what this amount includes, is the balance brought down at the beginning of the year. Okay, if you remember, when we declare a dividend, when the directors declares a final dividend, we always credit shareholders for dividends because those final dividends have been declared, but they have not been paid. And that will be then the balance brought down at the beginning of the next financial year. It will be those dividends that was declared last year, the final dividends declared in the previous year, but that hasn't been paid yet. And the first thing that we do in the new financial year is we pay the shareholders their dividends. All right. So whatever is the balance at the beginning of the year, the first thing we do is we pay the shareholders their outstanding dividends. So it will be part of the dividends that is being paid. Plus then during the course of the year, we will pay interim dividends. Should the directors declare interim dividends, they are obviously going to then declare and pay. Interim dividends, remember, is always declared and paid. So because it is paid, it also constitutes an outflow of funds. All right, so if we take the balance brought down at the beginning of the year, plus the interim dividends that we declared during the financial year, that is going to give us the dividends paid during the year, which always will be bracketed because it is paid. Okay, it has been paid. It constitutes an outflow of cash. An alternative way of doing or dealing with note 3, if you are not asked to prepare note 3, but you have to do the calculations to present the cash flow statement, okay, there's a different way of doing this. Okay, if we draw up a ledger account for shareholders for dividends, okay, first of all, we're going to have the balance brought down. Okay, the balance brought down is going to be the balance at the beginning of the year. Okay, at the end of the previous financial year, those final dividends that was declared but not yet paid, that goes into shareholders for dividends. On the credit side, balance brought down. Then we are going to take the dividends, the amounts in the financial statements, which would be the dividends for year 2. We are going to add that on the credit side as well. Okay, and then we are going to take the amount in the bank. Okay, so this is the dividends that have actually been paid. Okay, so it was the outstanding dividends. It would be the outstanding dividends that was outstanding at the beginning of the year, plus whatever interim dividends was paid. All right, any interim dividends that was paid during the year, okay, that is going to be added into this amount. And then the balance that is given at the end of the year, so whatever balance is left over at the end of the year, that is going to go on the debit side, obviously to be brought down on the credit side. Okay, easy. If we look at note 4, where we're going to calculate the amount of taxation paid, we again are going to start with the amounts in the financial statements, which again will always constitute an outflow of funds, so it is always going to be bracketed. We are then going to add the balance on the last day of the previous year. This obviously can be a debit balance or it can be a credit balance. If there is a credit balance, it will be bracketed, like in this case. If it was a debit balance, it would be unbracketed. It would not have the brackets. We then add the balance on the last day of the current year, and this works opposite. Okay? It can also be bracketed or unbracketed, depending on whether there was an inflow or an outflow of cash. If it is bracketed, it means that there was a debit balance. If it is not bracketed, like in this case, it means that there was a credit balance. When we add all of that together, it is going to give us the total amount, which is always going to be bracketed because it has been paid. Now, it says taxation paid. When we make a payment, there's obviously an outflow of cash, and therefore it is going to be bracketed. Again, if you are not asked to prepare note 4, but you just have to do the calculation, instead of drawing up the note, you can also represent the information in a ledger account. Okay, in this case, it will be the ledger account for SARS income tax. So again, we are going to start with the balance brought down. Okay, the balance brought down for this year, for the beginning of this financial year, is always going to be the balance on the last day of the previous year. Now, in this case, because this amount was bracketed, it has to be a credit balance. If this amount was not bracketed, there would be a balance brought down on the debit side. Okay, so you have to look at what they give you. Then we're going to add on the credit side, always on the credit side, we are going to put the amount that was in the financial statement, okay, the income tax for the second year, okay, the amount of income tax for the year 2. We're going to add that on the credit side. Then on the debit side, obviously we are subtracting the amount of taxes that was paid. All right, this will obviously be your interim taxes. Okay, the interim tax is the provisional tax, your provisional tax that you've paid during the year. Okay, and obviously the balance that was outstanding at the beginning of the year. If we owed SARS at the beginning of the year, again, if at the end of the previous financial year, SARS income tax has a credit balance, it means that we have to pay them still. We owe them taxes. And that would be one of the first things that we do. Same as with the shareholders for dividends. The first thing that we do in the new financial year is we paid the taxes that is outstanding. So this amount here would include the taxes that was due from the previous year, as well as the provisional tax that we have paid during this year. Okay, and then obviously we will balance this to get the balance on the last day of the current year, which would be the balance brought down for the next financial year. The amount that goes to the cash flow statement is the amount that was actually paid. Okay, remember, we can only put something in the cash flow statement if it was actually paid. If it still has to be paid, there was no changing of cash. If it still has to be received, there was no receiving of cash. We cannot capture that in a cash flow statement. It is only about cash that physically went out and cash that physically came in. Note 5 shows us information about the tangible assets that was purchased. Okay. Now in this example, land and buildings, there was nothing. Okay. We didn't purchase any tangible assets. For equipment, we didn't purchase any equipment. Vehicles, there was a purchasing of equipment, of vehicles. Okay. Now this amount, when we go to the cash flow statement, we add these three amounts together to give us the total amount of tangible assets purchased. Now when we purchase tangible assets, obviously it represents an outflow of cash. So on the face of the cash flow statement, this amount will always be bracketed. All right, always, because it is a purchase that is being made, so there will be an outflow of cash. All right, so on the face of the balance or on the cash flow statement, this amount is always going to be bracketed. All right. Here in the note, we're just taking whatever land and buildings and equipment and vehicles, whatever fixed assets we have purchased, we added together to get the amount. But we must remember that when we go to the face of the cash flow statement, it is always going to be bracketed, because when we are purchasing something, it represents an outflow of cash. Okay, the last thing that we're going to look at is the changes in the working capital. Okay, how do we calculate the changes in the working capital? This information will be obtained from the balance sheet. All right, so we're going to look at current assets and we're going to look at current liabilities. All right, for current assets, we look at inventory and trade and other receivables. Now, both of these can show both an increase or a decrease. If inventory is increasing, it means that we have bought more trading stock. So it will be because we bought more stuff, it will be a cash outflow, if it's an increase, it will have a bracketed amount to indicate that there was a cash outflow. If there was a decrease in inventory, that means that our trading stock has decreased. So we have sold more than what we have purchased. Therefore, there will be a net inflow of cash. Same with trade and other receivables. If it increases, we will bracket the amount because there was an outflow of cash. When it's decreasing from one year to the next, it means that there was an inflow of cash and it will not be bracketed. With your current liabilities, you will only have trade and other payables. This works opposite. If there's an increase, it means cash inflow, so there won't be a bracket. If there's a decrease from one year to the next, it will be bracketed because it shows that there was an outflow of cash. Okay, once again, when we talk about SARS income tax, remember SARS income tax can be part of trade and other receivables if it has a debit balance, or it can be part of trade and other payables with a credit balance. Regardless of where it's going to fall, we are not going to include it as part of the working capital on the cash flow statement, because it is shown separately. Right, with SARS income tax, we showed it in note 3. With the shareholders for dividends was note 3. SARS income tax was note 4. So we show it completely on its own. We can't show it twice. We can only show it once, and we show it separately as part of their own little notes. So we do not indicate them as part of trade and other receivables or trade and other payables. Okay, shareholders for dividends will obviously always be part of current liabilities. All right, but SARS income tax could be either a current asset or it can be a current liability, but we don't include it as part of the working capital because we show it separately. Okay, now to calculate the change in the working capital, what you're going to do is you're going to take your current assets, whatever the net effect was, cash inflow, outflow for the current assets, and you're going to minus your current liabilities, the net effect, whether it is positive or negative, cash inflow, cash outflow, and the two combined is going to give you the change in working capital. To determine whether there was an increase or a decrease in the working capital, the influence of the relevant transactions on the bank account will be taken into account. Remember, the bank account is where we put all the cash coming in or where the cash coming out is going out of. All right. So if we look at the effects of inventory and the debtors control and then the creditors control, if your inventory is increasing, which means that we bought more inventory, that is going to cause an outflow of cash because we paid for the increase. The stuff that we bought extra, we had to pay for. So it's an outflow of cash. If your inventory is decreasing, okay, which means we sold more inventory, that means that more money was received and that will constitute an inflow of cash. In terms of debtors controls, if there's an increase in our debtors control, in our debtors, that is going to cause an outflow of cash. If our debtors decrease, because now they are paying us the money that they're owing us, that is going to cause an inflow of cash. And then the creditors obviously work the opposite way. If there's a decrease in creditors because we have paid them, that means there was an outflow of cash. If there's an increase in creditors, it will cause an inflow of cash. Okay, so for inventory, just to summarize, if our inventory is increasing, it's causing an outflow of funds. If it decreases, there was an inflow of funds. In terms of our debtors, if there is an increase, that constitutes an outflow of funds. But if it decreases, it will cause an inflow of funds. And with your creditors, if it increases, it causes an inflow of funds. And if it decreases, it causes an outflow of funds. Okay, right, grade 12, so this is quite a mouthful. As I said, you're going to work through this today, and then tomorrow we will work together on an activity, the very first activity on the complete cash flow statement. We will do that one. I will do that one with you tomorrow. So this is all for today. Thank you.